Welcome back, everyone. This week we're going to do a shorter video, and I'd say a rather simple one, even though there's going to be some numbers involved, about portfolio management, position sizing, and how I do it, and how I think about it. So the primary takeaway here is that I try to stay in around 25% cash. That might go up, like currently I'm sitting in 38% cash. Other times it'll be zero. But I try to find a balance around that 25% cash level. The second takeaway is that I operate with a 20% position max, which is to say that any individual name I don't want to allocate more than 20% to, which is to say that no one name will be more than 20% of my portfolio when I at least initiate the position. And then the third takeaway is that I operate with a 33% thematic max, which is to say that I don't want any theme, whether that be offshore oil or uranium or home builders or whatever it may be at the time, to be more than 33% when I initiate it or size it up. Now it can get tricky because I said, for instance, offshore oil, but when you implement rules, you have to respect the spirit of the rule. So I could say, well, offshore oil is its own theme, while energy is a different theme, or it's a sub theme of a meta theme, because you could say that uranium and offshore oil are energy names, and as a consequence, you would limit how much you can size up your portfolio to those names. Now, I'm not going to buy 33% of offshore oil and then buy 33% of explorers and producers and so on and so forth. It's just offshore oil is my theme, 33%. No one name in that theme is more than 20% of my portfolio. So to put this simply, if I have $100 in my portfolio, no name can be more than $20 and no theme can be more than $33. Now, we're going to address these one by one. So I mentioned the 25% cash balance I would like to have, which is to say, in regards to this $100 portfolio, theoretical portfolio, I would have $25 of cash. But then you have to ask yourself, what kind of performance do your active names need in order to match the benchmark? So if the S&P, which is my benchmark, goes up 1% and I have 25% of my portfolio in cash, what kind of returns do I need out of the other 75% of my portfolio in order to break even with the S&P performance? And as you can see, the answer is, well, on the screen. So at 25% cash, my names need to go up 1.34%. So this is the beta coefficient of varying degrees of cash. And then logically enough, if I'm at 50% cash, then I would need all my names to perform on average, in aggregate, 2%. So right now I said I'm at 38% cash, which means that my stocks need to go up $1.60 for every dollar the S&P would gain. Now at some point of accumulating more and more cash in your portfolio decreases the probability of you outperforming your benchmark in the short term. Now, the reason that you would be building a cash hoard is to, well, deploy it at some point and to buy things. And what you're saying to yourself is, I think I can get, and this could be, many of fools have said this, and people do miss out on opportunities, but there's an opportunity cost. Your money's not actively deployed, therefore it's not making money because it's not invested. It's also not losing money. But you're saying, I think that I'm going to maybe sit on this cash for a year. Say the S&P goes up 10% and your entire portfolio is in 100% cash. So you underperformed by 10%. because you still are at $100 at the beginning of the year, $100 at the end of the year. The S&P went up 10%. You've underperformed 10%. And your thinking to that is something along the lines of, I think come January 1st of the following year, I'll be able to deploy capital and that year make, say, 20% because I'll be buying at a lower cost basis in whatever names or themes that you might be actively looking at that's on your buy list. And then say the S&P goes up 5% that subsequent year. So on a 2-year time weighted or 2-year period, the S&P is up 15%, but now you're up 20%, even though you sat out of the market for 1 year. Now, this can go horribly wrong for all sorts of reasons, but if you didn't believe this to some extent, then you would never have cash in your portfolio. So if you have cash in your portfolio, you are telling yourself, I think I can get in at a better cost basis than what I'm currently in. And that's just how that goes. It also dampens volatility. So you might raise cash and degross if you think the market's going to be volatile and or decline. And then that helps buffer any decline. So instead of being 100% invested, you're only 75% invested, which means that a drawdown in your names will impact your overall portfolio performance less and less. On to the second key takeaway, position max. So as I said, 20% of total portfolio is a position max. So Transocean, Valaris, Tidewater, Sprout, uranium miners, whatever the name might be, no more than 20% of total portfolio. Now, this is really interesting, and a lot of, maybe some thought needs to be put on this. Because if you're sitting in 25% cash, that means that 20% that you've invested is actually controlling 26.6% of your portfolio's performance. Now, there's a lot of reasons that you might... So what's some reasons why I do the 20%? Well, it's an arbitrary number. It could be 25%, it could be 15%, but it's a psychologically satisfying number. And it seems intuitively right enough. And you're capping upsides, but you're also capping downside. And in a few slides, I'll show you what capping your upside looks like, and I'll show you what capping your downside looks like. But just know that don't have a false sense of security thinking to yourself, and this number might be whatever you choose, 10%, 50%, I don't know. But just know that that 20%, if you're sitting in any reasonable amount of cash, means that that name actually has a disproportionate outsized impact on your portfolio's performance. So let's ask the question, what happens when a maxed out position name moves up 50%, all else being equal, which is not reality, but it helps us in this thought experiment. So you have a name, 20%, let's say that's Transocean, moves up 50%. I'm in 25% cash, I have 20% of my portfolio in Transocean, it moves up 50%. What happens? Well, cash is now less than 25% of your portfolio due to the position run-up. Your portfolio, that $100 portfolio, would now be a $110 portfolio. And $25 divided into 110 is less than 25%. That's just arithmetic. So what happens is 27.2% of your portfolio, of your total portfolio, is now invested in Transocean. And here's the, I don't want to say scary part, but the part that you need to be aware of, which is that 35% of your active positions is under the influence of a single name now. Which is to say that 1/3 of the movement in your portfolio, and as a consequence your profits and or losses, is under the influence of a single name. And then another question that you need to have an answer to, because if you don't, and you haven't given this conscious consideration, then it means whatever fleeting emotional whim you have will decide for you. Which is to say that either you're sell prematurely or sell too late. Which is to say that you'll leave a lot of profits on the table because you want to lock in profits. That's, prospect theory. Or you'll wait to panic at the bottom of a dump and then erase all the gains you had. Which is why you need to give it conscious consideration. And that question that you need to give conscious consideration to is, do you have to degross or reweigh your portfolio to stay in position parameters? And when? So if I have a position max of an individual name at 20% of my portfolio, do I have to reweigh it on a quarterly basis to knock it back down to 20%? You might recognize that as one of the aphorisms in the financial community is to take profits on the way up. So that's what this would be, is taking profits on the way up. It goes up 50%. You take 25% of your position off the table, and then you do that on a quarterly basis, and then maybe the stock falls a bunch in the second quarter, so then it's now only 15% of your portfolio, so then you can add back more, and this trimming and adding active management of the portfolio, is that how you want to go about it? Or, as I said initially at the beginning of this video, the initiation of a portfolio or the initiation of a position, which is to say that I'm the kind of person, depending upon the situation, now let the winners run. Some of the names I have, I will either sell out of and or parts of once they hit certain percentage gains. But other names, I'm more bullish on in secular terms, and I know that there's going to be shakeouts along the way, and that I need the fortitude to manage that and to not take profits. And sometimes you end up round tripping an investment a couple of times as a consequence, and you sell at a little loss, and you wasted the opportunity cost of that money for a year or two. So that happens. So you need to decide these things for yourself. So here's a couple of examples that I spoke of a moment ago. This is Amazon. So how many people called the secular theme right on Amazon, yet had to sell down their positions for compliance and or risk reasons? That compliance and risk reasons would be the bylaws and in a hedge fund or something like that says, you got to take down exposure, degross at certain times after a position run up or move, however they parameterize it. But how many people get the secular themes of things correctly, but can't sit through the volatility of it? And how many people call a secular theme correctly and are just too eager to take profits? It's not like they're recycling their capital into something else just as promising. They're not doing that. They're merely taking profits to take profits. So here's Amazon, beginning of January 2014 to, the past week. It's up 600%. Now, talk about radical volatility in the last couple of years, but whatever. So it's up 600%. How many people who bought in January of 2014 sold their position a year in, 6 months in, 2 years in? A quick double, right? They put in $100, they made $200, they took the money out, they took the profits. Those are exceptional annualized returns. Why wouldn't you take profits, right? That's the rhetorical smokescreen, ostensibly true kind of question that's really more of a dismissive detraction from actually answering the question. Why wouldn't you take profits? And the answer is, so I can make 600% instead of 100%. Like, that's the answer. Why? Like, so many people call so many secular themes correctly. And then another interesting thing you see a lot in investing is people call secular themes correctly and then lose tons of money. Not only miss out on the opportunity cost of making counterfactual, theoretical more money, but they lose a lot of money. Think the cannabis industry. How many people call that correctly? The TAM, total addressable market, has been growing. More and more people are adopting it. More states are adopting it to be US focused here. The industry is expanding. The markets are growing. Revenues are increasing, so on and so forth. And yet, most of those names are down 90%. And they fail to understand the arc of development of new industry, whether that's canal creating in the 1800s or railroads in the 1800s or the rubber boom in the early 1900s or the cannabis boom of 2017. Capital flies in, competes away profits. It's a race to the bottom. They take on a lot of debt. They run down the price of the product. None of them make profit. They get turned upside down on all the leverage they have. They go bankrupt. The industry consolidates. And then the leaders reemerge. It's a story as old in time. Tomorrow's Gold is an excellent book to understand such concepts. And it just rinses and repeats itself time and time again. And yet people thought EVs were any different. Like, you literally had an automobile boom in the early 1900s that you could have drew inference from to understand how the EV boom this time would play out. And yet people are historically ignorant. They have loss of institutional knowledge, and they're personally incredulous. That is a recipe for disaster. And sure enough, disaster struck many investors who didn't want to listen to the teachings and lessons of history, and or to think it through, and or to listen to the naysayers. And yet, EVs are picking up, the markets are expanding, yet the stocks are down horribly. Now some of them in 30 years might be up 10 times off their all-time highs. But what's the probability of you accurately picking those and making up for the money that you lost initially, and then the opportunity cost of the money that you have to sit through for all these years to get back to all-time highs? We saw that in the dot-com bubble. It just doesn't stop. There's so many episodes that this has happened throughout history that you should know these things better. Okay. Now, we need to be fair. There are reasons why, even though you believe in a secular theme, that you might want to take profits on the way up. And perhaps to have some idea of what fair value of a stock is. This is Global Atomic Corp. For those who don't know, Niger had a, let's call it a military coup in the last few weeks. And Global Atomic Corp, uranium miner, just so happens to operate in Niger. There was a scare a couple of months ago about nationalization. So, had you bought at these lows, around the 50-cent levels, I don't know, anywhere between 2013 and 2020, the thing ramped hard in late 2020, you could have almost got a, 8-bagger, let's say, and now it's down 70% from all-time highs, and in the last week, it's just fallen off of a cliff. And then these are reasons why, although you're bullish, let's say you had a 33% allocation to the theme, and then a 20% of that was in a single name. Let's say that name was Global Atomic. And then the thing runs up from 50 cents to $4 within close to a year's time. This is why you take profits off the table. This is a reason to support why you take profits off the table. This is a reason why you reweight the names you have. Now, the problem is commodity cyclical names are never long-term holds. They're destructive to capital over a long enough period of time. And just look at GDX. How much has gold gone up in the last 2 decades? Now look at how much gold miner names in general and in aggregate have gone up in 2 decades. There's reasons to that. Cost inflation, production, mismanagement, so on and so forth. So although you might say something like there's a secular trend to uranium, yet again, that doesn't mean that it's necessarily a profitable trade and or that you're going to be able to profit. The railroad stocks in the 1800s peaked years before expansion of the railroads came to a halt due to an economic crisis. And that's interesting. It's like, well, why would the stock be going down when they're expanding their networks and theoretically thus the revenues and thus the earnings and the dividends and all that stuff? And that's because it's a cyclical industry in a secular theme, and there's a time to get out even though the theme's not done playing out. And that's really hard to gauge, and there's so much nuance in that it's beyond the scope of this video, and that presupposes I have enough clarity on the topic to afford you any insight in the matter, and I'm not just pathologizing you with my own corrupt thought. So I'll save you on that and not talk about it. So on to the third key takeaway, the 33% thematic max. One of these reasons for these maxes is it's also, as I said, they capture upside, but they also capture downside. A down 50% year requires an up 100% year to get back to the high water mark and break even. And that's really worth thinking about. So the thematic max is 33% of my total portfolio. So if I in 25% cash, that means that it's actually 44% of my active portfolio, which is to say that almost here I am trying to fool myself in a false sense of security, thinking that I'm quote unquote diversified with only a third of my portfolio in a theme. But in reality, if I'm sitting in 25% cash, half of my portfolio's performance is going to be the consequence of a single theme. And then if I have a 20% of total portfolio in that particular theme, then that's a third. So I have a third of my active portfolio in a name, and that stock is an expression of a theme which is controlling half of my portfolio. So this can give you a lot of upside if you get it right and a lot of downside if you get it wrong. So what happens when a 50% move, like the one we did as a thought experiment for the position size, what happens if a 50% move happens in a maxed out theme, all else being equal? Well, now that theme, as I alluded to, is 42% of your total portfolio and 54% of your active positions, which is to say that it's over half your book. Whatever profits or losses you have, over half of that will be the consequence of this. And given enough time, it can get worse or better, however you want to look at it. Off kilter, maybe is a better word, less moralizing. Off kilter because just imagine if you invested in Tidewater or Valaris or Transocean in 2022. You'd be up over 100%. Now let's say you maxed out the positions and you maxed out the theme. You would have a much larger part of your active positions influencing your portfolio. You're essentially an offshore oil portfolio. And as the video, I think it was last week that I presented about the BP oil spill, and you see how radically the price drops, or how radically after the Fukushima incident, the price drops. Cameco's down 12% by the end of the first day after the Fukushima incident. Now just imagine 54 or let's say 33% of your portfolio is in Cameco, and then it falls 12% in a day, which is to say that 33% of your active portfolio fell in a day. Now you can start understanding between this video and that video why you want to have some guiding principles and rules. And it also brings into question, what do you do with winners? Now with losers, interestingly enough, it becomes a smaller and smaller percentage of your portfolio, which allows you to add more and more if you believe in the theme and have conviction in the idea. And then the question is, if you don't, why do you own it to begin with? Unless it's just a trade, and don't make trades holds and other aphorisms that the financial industry affords us. Oh, there was one more point I wanted to make on this. I can't remember what it is. So yeah, to sum this up, because the next slide is going to be my weekly performance, is what do you do with your names once they run up? Do you sell them? Do you hold on to them? That's another reason why I have this constant cash flow in my portfolio, because it helps balance these things out. Although my names might be going up, but they also can hurt you, because as the, I think, second slide suggested, once you get too much cash built up, it's going to be difficult for you to outperform the market. And if your names are just on a tear, ripping up, then it'll probably offset the cash that's being contributed to your portfolio. Oh, I know what I wanted to say. Now, part of this channel, Cup of Coffee Capital, is about what is it like, what do I expect, what should I think about when starting a portfolio? That's part of this channel. And what you have to come to understand is percentage moves. And what I mean by that is, to keep it simple, say you contribute $50 a week to your stock portfolio. January 1st happens, you deposit $50. When week 2 comes around, you've doubled the size of your portfolio because you've added $50. Okay, so you went from $50 to $100. Your portfolio doubled in the second week. And then it takes another 2 weeks for it to double. And then it takes a month to double. And on it goes. And let's say Transocean, let's use real life example. Transocean, at the beginning of January 1st of this year, it's when Cup of Coffee Capital came to exist, Transocean was at a place that I wanted to buy, price-wise. Now, I didn't buy it because I wanted to buy on a pullback. I don't want to buy after a run-up, which it was on a run-up from December, a very nice run-up, but it kept running up all of January. And I think I finally bought, you could say FOMO, at some point in January, I believe. I initiated my position, but I was hesitant to invest too much. I was sitting in a lot of cash at the beginning of the year relative to the portfolio, but I didn't have any position. So, I mean, if I deposit $50 in the first week, I'm now 100% cash. So you kind of want to get the ball rolling. And both for entertainment purposes, for being a channel like this, but also, well, to start compounding your money. And you then have to ask yourself, okay, I buy Transocean. Let's say I buy $50 worth. Well, I'm now 100% concentrated. Okay, well, I thought that no name should be more than 20%. Now I'm 100%. But when growing the portfolio initially, all of this is out the window. If it's at a cost basis that you would like to deploy capital at the beginning of your journey, of the genesis of your investing, then these rules don't apply, because you're just trying to establish a base. And it's easy if you mess up. You know, if you spend all $50 in the first week on Transocean, and then the second week it pulls back 30%, like, it's okay. And it's okay because you have another $50 immediately to lower your cost basis, and the amount of money that will be flooding in is going to offset that radically. Now think about that differently. Say it's December 31st of that year. Okay, at that point you've spent 52 weeks contributing $50 a week. That's roughly, well, it's $2,600. We'll call it $2,500 to keep things simple. At that point, or even at this point I'm at now, these rules, these these key ideas of thematic max, position max, and cash treasury all become more and more relevant because it's now going to take a year for me to double my portfolio size insofar as cash flows are concerned, i.e. that $50 a week. So you need to be more diligent in how you manage your positions. At first, you're just trying to build up positions. You're going to blow out your theme max, your position max, your 25% cash isn't even going to be a thought. Like, it's not necessary, especially those first few weeks. And that's growth isn't linear in most things, whether it's exercise and gaining strength. There's plateaus and there's pullbacks and there's setbacks and there's obstacles and there's things that inhibit you, and then you plateau and then you have another growth spurt, and then exponential hockey stick functions occur, and so on and so forth, like I've detailed in other videos. A lot of my names for February, March, April, May, they traded sideways. That's 5 months of trading sideways. And then July or June or July, I can't remember anymore, came along. I think it was June, and then 3 of the days in June rocketed my portfolio by 10% in a single month. And as I've pointed out in uranium videos, the uranium price spikes really hard for about a month, then it trades sideways for a year, then it spikes really hard in a month. And so you're trying to have exposure for the breakout instead of buying the breakout, because when you're buying the breakout, you need to be of the psychological type that can manage to size up something, to size up a position rapidly, buying on 5 or 10% up days. Because it's either that or you buy a name and let it trade in a 20% range, 10% up or 10% down for the next, as I did, 4 or 5 months. And it's frustrating, as I did, to buy Transocean, to start sizing up on it at the beginning of the year after missing out on the January run, and then having it go nowhere except primarily down or sideways for subsequent months. But it is what it is. But what you're trying to do is size up for the next move. And hopefully, I don't want to say hopefully, but I hope's not a good strategy, that moves to the upside. But you always leave enough on the table, that's what the 25% cash is, for if the name retraces, there's a pan sell-off in the overall market or whatever it may be, that will then afford you to be able to average down and or initiate into new positions that you're interested in. There's a couple of names that I've wanted to buy all year, and I've not bought them because I thought they would go lower. And they went low, and I thought they'd go lower, and then they went up higher. And then they went low, and then I thought they might go, and I completely missed out on them. And which means I'm going to have to buy much higher at some point, or just not get involved in the trade. But the names I'm thinking about, one of them in particular, I'm just going to have to bite the bullet and just start averaging in. And yet again, I don't want to say hope for the best, because I still think it's an attractive investment, but to know that it's going to probably be dead money to down money for subsequent months and quarters. And that's because I missed out on it. I was focused on investing in other things. I was focused on building a cash position, and like the home builder names really inflected a lot harder than I thought. And that's kind of the industry I'm talking about right now. And or names within that industry are tangentially associated to that industry. So with that said, let's get into the weekly recap of my portfolio. Tidewater is doing amazing. I mean, it really is. It's one of those things. I heard a saying that says, you've position sized correctly when you wish you bought more. Like, you always want to buy stock. This is how the advice went. You want to buy it, but not so much of it that you can't sleep at night, which means that when it goes up, you will have wished that you bought more. And Tidewater is actually probably one of the most solid conviction trades I have, and yeah, I couldn't have. I've struggled to bring myself to make it a sizable position. The name I want to talk about, which prompted me to go to this slide, is that Louisiana Pacific (LPX) got hit hard this week. Earnings came out not so hot, and as I figured, it is such a frustrating name, and I don't know what's going to happen in the long run. I would like to think it goes up, but my goodness. It and BXC, BlueLinx, have been in this sideways range for, I don't know, 18 months, 2 years now, while Builders First Source, one of the names I'd like to buy that I've completely missed out on, 100% plus return this year. Louisiana Pacific double topped. And then BlueLinx is, depending on how you want to measure it, is either a triple top or a 5 times top. And it's just in this trading range, while Builders First Source reported, and they're, well, it might be breaking out to an all-time high. It's up. It traded sideways on earnings and then closed Friday up 3 or 4%. It's just like, well, I got in the wrong name. Right industry, wrong name, which is a lesson in and of itself that I'm not going to belabor at this point. And then I guess you could say another thing, Valaris signed a contract. They're doing well. The interesting thing about Valaris is you go online and read these articles, and when Valaris was down on the year, which I don't think it is anymore, it's still off of its all-time high, but when it was doing poorly a few months back, nothing but bearish articles were being written. And now with it doing well and bouncing pretty steadily off of that year-to-date low, guess what? All these bullish articles have been coming out. And then you might ask, what's fundamentally changed with Valaris or the offshore oil sector? And the answer is, not too much. I mean, some things, more positive things are occurring. But why so bearish? Like, you would think that with it trading at a discount to replacement cost or whatever, however you want to value it or calculate it, that would be the time to accumulate. But here everybody is telling you to sell. And then with it off of its lows, everyone's telling you to buy. Like, now, I'm not saying it's not even a good buying point. I'm simply saying it's very interesting to see how bearishness and bullishness is predicated upon short-term price volatility of the sector. And then URNM, my tease of a stock and position, is up on the week. And that's, well, the whole Niger situation that I touched upon earlier with Global Atomic has the uranium sector kind of bustling because, well, if the producers in Niger aren't going to be able to sell, or they won't sell, depending upon the mandates of the military coup and all the drama that's going on in there, then that means that there might be less pounds on the market, which means that better pricing power and other producers will get looked upon to produce for the utilities and such. So it's up on the week, so that's nice. So that's really all I have this week. So I'll leave it at that, and thank you for watching, and until next time.